What's going on, Premium Chasers? I hope you're having a God-blessed day. In today's tutorial video, I'm going to be showing you how to sell covered calls using the SoFi Invest app. And if you just drop a comment down below in today's video, you're going to get the full SoFi Invest options trading guide completely for free. Down below, just drop a comment and hit that like button and that subscribe button. Let's go over the shoulder. So first and foremost, you need to have a SoFi Invest account set up. So if you don't already have that, go to SoFi.com. I have no affiliate link here to give you, right? So go ahead, go over to SoFi and make sure you have a SoFi account already set up. The next thing you're going to want to do is submit for options approval, and that is very quick. You'll see that right under your invest section, and it might take 2 to 3 days before you're fully approved for options trading level 1. So you want to make sure you get approved for level 1 options trading, because that is what's going to allow you to sell covered calls on SoFi. So a quick rundown of what an actual covered call is. A covered call is simply this: us saying that we're willing to sell 100 shares of our stock on a certain date and time and for a price that we choose. I love this strategy, and I tell all of my friends and family about it, and I kind of say it's like renting out your stocks on a weekly or monthly basis. So right here you could see I'm here all trading SoFi on the SoFi app. Talk about inception. And the first thing you need to do is you need to have 100 shares of a stock to do this strategy, okay? So for example, let's say SoFi right here, you need 100 shares of this stock. So the first thing you're gonna need to do is go buy 100 shares of the stock, okay? So that could be SoFi, it could be SPY, it could be any stock that you want, right? You need to have 100 shares. That is a prerequisite to doing a covered call. Now, after you have those 100 shares, the next thing that we then do, and you can see I actually have a live trade here, and we'll cover that here in just a moment of a covered call here. But the next thing we want to do after you have your 100 shares is go to the trade options section, right? Now, this is called the options chain, and it can look a little intimidating if you've never looked at it before, but it's very simple once you get used to it. The first thing we need to do is go from buying to selling, right? We are options sellers, not options buyers. We are collecting premium, not giving away premium. When you're an options buyer, right, you're paying to control 100 shares of a stock, right? But as an option seller, you already own 100 shares of a stock, and you're collecting a premium from an options buyer who wants to control your 100 shares of stock, essentially, right? So the first thing we want to do is switch over to be an option seller. And then the next thing we want to do is make sure we are in the right place of selling a call. And that means that we are now selling a covered call on 100 shares of a stock. One options contract is equal to 100 shares. Those are the rules. That's just the way it is, okay? So the next thing we want to do is select our expiration date. The two most common ones that you will see and most likely run yourself are going to be weeklies or monthlies. If you're a beginner, I recommend sticking with monthlies. That gives you enough time to work on your favor and to really learn the ropes of selling options, because managing your positions, rolling your positions, all just take time, as option selling doesn't really require you to be an active trader. Okay, so right here we can see our expiration, and you can see right here I have 11/14. That's obviously only 1 day away. So I can open this up and I would select, let's say we want to do 30 days out. So I'll do 29 days, right? Just around 30 for the 12/12 expiration. So all I'm saying here is I'm willing to sell 100 shares of my stock on December 12th. Okay. Now the cool part is I get to name my price. I get to name my price that I'd be willing to buy 100 shares. So in this example, we're going to assume that you bought your 100 shares of SoFi and then just did this strategy on that. And then this strategy is called a buy right strategy. It means you're buying 100 shares of a stock and then immediately running a covered call on it, right? And getting it to generate income for you, right? So let's just say you bought 100 shares of SoFi at $30, just to make it simple math, right around the current market value. Now from here, we obviously want to sell them for a much higher price than what we bought them for, okay? We want to buy low and sell high. And that's why I love option selling, is because it really forces me to buy low and sell high. So right here, you could see I get to name my price. I could do 31s, I could do 32, 33, 34, 35, and so on and so on. But understand that the further out you go, right, away from the current market value, right, the less premium you're going to collect up front. So for example, if you were saying, hey, I bought them for 30 and I'm willing to sell them for 31, you would collect $200 of premium. You can see this estimated credit right here is $200 of premium. That's a lot of money. If I toss this, I always like to have everything into my covered call calculator, and you can download this calculator for free by attending our workshop. Click the first link in the description. But you can see I'm collecting $201. My strike of the option here is, what did we say? Selling it for 31. Our purchase strike price is the current market value of around 30. Man, you're getting a 6.7% return on your collateral, right? That's 201 divided by $3,000. That $3,000 that you spent to buy 100 shares at 30, right? That's 6.7% return. Now, this just basically means that this is a high risk chance of you actually selling your shares. So I'm just going to uncheck this, and let's just go take a look at, for example, the 32s. You could see here that I'm collecting 160, right? If I'm selling them for 32, right? And if I want to sell them even, let's say 35, I'm collecting 86. Now, what's the ideal scenario here? Well, for me, I go and look at the delta, okay? I look at the delta, and that is really what's going to tell me my probability of assignment, especially if you're somebody that's a busy person and doesn't have necessarily so much time to go into all the technicals and all of that. A delta is a quick and dirty way to kind of see what is your chance of assignment. So for example, on these 35s right here, if I scroll down, I open up this options chain right here by clicking this little arrow, right? And you will see that the Greeks are right here. Now, the most important one of the Greeks, in my personal opinion, that you are going to care about is going to be this delta. And this delta being a 0.28, call it 0.30. There's a 30% chance that you will have to sell your shares at $35, or the way I like to look at it is a 70% chance that I'm not going to have to sell my shares. What do I mean by that? Well, let's just plug this all into our calculator, and I'll show it exactly what I mean. So $86 is the premium that we would collect if we did this specific trade. So I'll go over to my calculator here, and again, you could download this in the first link in the description. Our strike of the option, that's what we're willing to sell it for, is 35, and our purchase strike price is 30. Now, let's say the 12th of December rolled around, right? That's the day, right? Now, that's the most important day at close. What is the price of SoFi trading at close on the 12th? If it's trading below $35, that means you're not selling your shares because it's not trading at $35. So your contract will expire worthless, it's called, and you will be returned back your 100 shares or however many contracts you did. And you can, of course, do, like, let's say 5 contracts right here. Obviously, you collect more premium, but that would require you to have 500 shares. Okay. And that's a very common strategy, right? To do multiple contracts to collect more premium, put your shares to work. The second thing that can happen, and this will be the biggest risk of the covered call strategy that you'll find, is you are essentially capping your gains here. Your max potential profit on this specific trade is going to be $586, right? That's the $500 of profit if you bought them at 30, sold them for 35, plus the $86 of premium that you collected for $586 of total profit. You get nothing more. That means that if on the 12th at close, SoFi is trading at 36, 37, 38, 39, right? You are missing out on any further gains on SoFi. You are selling your shares at $35, and that is it. Okay. So with knowing that, right, you want to take that into account on do you actually want to sell your shares, right? Some of us have really good cost bases on stocks, right? That we maybe really don't want to do a 70-30, right? That might be a little too aggressive. We might want to be going a little bit further out to make it really worth our while. In my personal opinion, though, I like to sell my stocks, even though that might trigger a taxable event. In my personal opinion, I rather lock in real gains than fake paper gains, especially when I'm selling options. When I'm selling options, I like to treat this as a business. So in this specific example, if I bought my shares at $30, I would gladly sell them for $35 the following month, right? Because I know, right, how quickly the market can especially turn on us. So if I go back here, I want to show you guys a position that I'm actually in right now. So if I click into this specific stock or into this specific contract, you can see I have a SoFi 29 call on 11/14, okay? So that is actually tomorrow. So this covered call is saying that I'm willing willing to sell my 100 shares of SoFi for $29 tomorrow. Okay. Now I purchased these my shares for a cost basis of around $26.50. So my trade looked like this, right? So my premium that I collected here, it wasn't that much because I actually only did this one on a weekly basis. It was like $34 I collected. I bought my shares for around $26.50, right, when it dropped last Friday, and then I immediately ran covered calls for $29 for expiring for tomorrow. Now I got about a 1.28% collateral return. Now this is a weekly, right? This is a weekly. In a single week, I got a 1.28% return. When I saw that SoFi had a nice drop on Friday, I scooped up and bought 100 shares, and then immediately said I'd sell them the following week for $29. And in a position like this, I will gladly take a nice juicy gain like that if I sell my shares the following week, getting in and getting out of that position. If you enjoyed today's video, make sure to like, follow, and subscribe. Drop any questions that you have down below and click that first link in the description of today's video. You're going to get my full trade log to keep yourself organized with your covered calls. You're going to also get my covered call calculator that I was demonstrating in today's video, along with a bunch of other bonuses. Click that first link in the description of today's video. And remember, sell options, collect premiums, repeat. I'll see y'all tomorrow.